Welcome to Forex.com's webinar series. Before we begin, let's go over a couple of disclosures.
Hi, I'd like to welcome everyone to our class. This is our introduction to support and resistance. My name is Kelly Durazo. I'll be your instructor for today's class. Now, when technically analyzing Forex charts, one of the key factors is identifying support and resistance. In fact, identifying support and resistance along with the prevailing trend really is the most important aspect of your technical analysis. And that's why we've created this presentation to really go over this area in depth. And so we're going to use these support and resistance levels to identify possible trading opportunities in the market. So some of the topics that we'll be discussing during our webinar today is first we're going to start with what support and resistance is. Usually we have quite a few different levels of traders on our webinars, so I really want to start with giving you a very good foundation, starting with the basics and talking about what support and resistance is, and we're just going to build on that as we go, getting a little bit more advanced through our class. We're going to talk about why support and resistance is so important to learn, support and resistance, how it's linked to the trend, and then I'm going to help you identify what we call key major support and resistance levels. And then we're going to use support and resistance with a very specific trading strategy that I'm introducing to you today. Now, there are quite a few different strategies that you can use to trade this market. This is just one of many. However, this is really a great one, really one that we call a universal strategy, because anyone can use this strategy, anyone from the beginner level to the advanced level trader. You can use it on any currency pair and any time frame that you like to trade from, and you'll be able to walk away from our class today with this specific trading strategy under your belt. So to begin with, let's start with talking about what support and resistance is. Now, support and resistance, these are points on a chart where the odds favor a halt, even if it's just temporarily in the current trend. Basically, you want to think of support as being a significant low price area in the market, like a floor area, and the resistance is being a significant high price area in the market, like a ceiling area. Now, the best way for me to really show you what support and resistance is to use a building analogy. So I want you to look at this multi-story building here in front of you, and this is going to represent the market. Now each story has a floor that represents the support. It also has a ceiling that represents the resistance. So in an uptrend, the market will oftentimes break through the ceiling to the next floor. Now it's creating a new floor or support, also creating a new ceiling or a new resistance area. And then of course the opposite is true in a downtrend. So starting with our first chart, I'm going to be showing you quite a few different charting examples today. These are just typical charts that a Forex trader would use to analyze the market. These are charts that we do offer free on our trading platform. Now here we can see that we're looking at a Euro-Yen chart, a 15-minute time frame, so great for some day trading, those small time frames. And we can see that the prices have dropped to this low price area here. And as you can see, it's hit that same price area a couple different times. So the fact that the prices are moving down, that's telling us that those sellers have taken over, pushing those prices down further and further. And now they've hit sort of an invisible barrier, creating a nice floor area, a nice support area. It bounces off of that, and then we can see that they're going to try again, coming back to that area, trying to get the prices lower than that. We can see that the sellers weren't able to do that as the market just bounced off of that price area. And then you can see the prices take over. If it's moving up like that, that means that those buyers have taken over, those bulls, if you will. But here we can very easily see that nice support area that the market has created. Now, just the opposite, we have an uptrend, again, 15-minute time frame, different currency pair, dollar again we're looking at. We can see that the prices have risen up to this high price area here, hitting it quite a few times, meaning that those buyers have come up and they've just kind of stalled at this point, creating that invisible barrier. And then eventually those sellers took over as the prices just bounced off of that high price area, that nice resistance that the market hit. Now, what we're going to do is we're going to start with talking about how support and resistance is linked to the trend. I'm going to give you an introduction here, and then we'll come back to this in a few moments. But as you can see here on this chart, the market moves in a series of peaks. Those are those resistance areas, and then troughs, those support areas. Or maybe you've heard of them referred to as spikes and dips in the market. And the level and direction of these peaks determines the trend. So for example, on this chart in front of you, we can see that those low prices are getting higher. We can also see that those high prices are getting higher, and this is very indicative of what we call an uptrend. Now, in an uptrend, though, what we're going to do is we're just going to connect those support areas. We're going to connect them with a trend line, kind of like connecting A to B to C, and then so on. And then by doing that, we can just take a step back. We can very easily just take a quick look at this chart and see that this currency pair is definitely trending up. And that trend line is acting as an angled support area in this case. Of course, what goes up will eventually come down. So the second way the market can move is in a downtrend. So with this downtrend, we can see that those high prices are getting lower. Those lows are also getting lower. However, this time what we want to do is we want to connect the resistance areas with our trend line. Remember, in an uptrend, we connect the support areas. In a downtrend, we do the opposite. We're going to connect those resistance areas. And again, when we do that, we can just very easily, quickly look and see that this currency pair is definitely trending down. Now, we're going to begin with our first exercise, and all of these exercises that we do throughout our class are ones that you can recreate on your own charts. You can go back in and recreate this so that you can study those on your own when you have a little bit more time. And what we're doing first is we're actually going to show you how to identify support and resistance on your charts. Now, again, this is a typical chart a Forex trader would use to analyze the market. And when you're first beginning to really look at these types of charts, let's say you're very new to this type of market, they can look a little overwhelming, right? Because they are very technical. However, as we go through our class today, I'm really going to show you how to break these down and be able to read these charts so that you understand what's really going on when you're looking at these charts. So what we're doing first is we're going to go ahead and identify support and resistance on, again, this typical chart. Let's go ahead and start at the beginning. Here we can see that the prices rose to this high price area eventually here, and then we see that we have a retracement, what we commonly refer to as a pullback. Now, this is the lowest price area that the market was able to pull back to, creating that nice support, that nice floor, bounced off of that, and then look at this, it came back down again. The more times it comes back down to that same price area, the more significant that price area is becoming. Now we can see that the market is moving up. Now, the market is always moving in one of three directions on your charts. Either we have uptrends, downtrends, we've seen both of those, or the market is moving sideways, what we call a ranging market or consolidation or a channel. This means that there are an equal amount of buyers and sellers in the market, just pushing those prices sideways for an extended period of time. Really, no one has won out as far as those buyers and sellers. We kind of have a stalemate going on. And as you can see, the support level, instead of getting higher, in this case, we have a nice uptrend. We can see that they've leveled out, and that is the same with the resistance areas. They've really leveled out, giving us that sideways movement. Now, eventually, that sideways movement, it won't continue on indefinitely. Just like those trends, eventually you're going to see one side or the other break through, either that support or that resistance. And I'm going to give you an introduction to our trading strategy right now, even though we are going to come back in a few minutes and we're going to go through some very specific charts, really getting into that trading strategy. But I want to introduce it to you now because I want to show you different areas that we could have possibly gotten into on trades using this particular strategy. And this strategy is called the breakout of support or the breakout of resistance. And it's all based on that sideways movement. So anytime you see a currency pair moving sideways, you would really focus in to see if this particular strategy is setting up. and you would identify that support as the market was moving sideways. You identify the resistance, and then we're just waiting for the breakout. If it breaks above the resistance, we're going to buy right above that price area. If it breaks below the support, we're going to sell right below that price area. Now, as you can see, in this case, the market eventually broke through the resistance. So as it broke through, this would have been a great opportunity for us to buy upon that breakout, buying right above that resistance area, anticipating that those prices were going to keep climbing higher, which we can see that they did. Notice we have this nice uptrend started, and within that trend, many times you'll see that sideways movement. And so here we have it again. So we identify that support, identify the resistance, buy above the resistance area, and then we can see that the market really took off, finally topping out, giving us this nice resistance here, this nice support. Of course, we could go the opposite direction. That's the great thing about this market is we can buy and we can sell. So now we have some downward movement. We could simply sell right below that support level. We see we have that nice breakout. And then look at this price area here. We see we have a pullback, which is very common. A lot of times you'll see a breakout, and then you'll see a pullback before the market turns around and keeps going in that downward direction in this case. And as you can see, the market pulled back right up to that previous support area, making it a resistance area. We call that role reversal, and we'll talk about that in a moment. And that's very common to see this market do that. Now, one question I always get in relation to a ranging market, the question I always get is there a specific amount of pips that the market will range to consider it a range? And the answer to that is no. You can see a very tight range, maybe even 20 pips, maybe some of those yen currencies, um, all the way up to really hundreds of pips. So we can see the difference here. We can see this currency pair is moving sideways. It's moving sideways in a range that's literally hundreds of pips. This one back here, much smaller, much tighter. Doesn't matter. It's still going to be considered a ranging currency pair. Now we'll just quickly go through a downtrend, just really training your eyes to be able to spot these different support and resistance levels. And you can see them going all the way down. Our highs are getting lower. Our lows are also getting lower. What will eventually happen is with a trending currency pair, it's eventually going to exhaust itself and become either overbought or oversold. In this case, we can see that it is definitely oversold, and we can see that the market is starting to move sideways. So anytime a currency pair has been trending for a while and then it starts moving sideways, we really want to focus in to see if something major may be happening. This fact that it's moving sideways could be telling us that it has become oversold and really extended itself, and it may be about to turn around and do a pullback, a retracement, or maybe turn around completely, giving us a new direction in that trend. So here what we see is that the market is bottoming out, creating a nice support as it's moving sideways. So one of two things could happen here. Either the market would have eventually broke through that support, continuing that downtrend. Had that happened, we simply could have sold here right below that support upon the breakout. Or what could have happened, actually did happen in this case, is as the market's moving sideways, we identified that support. We would also identify that resistance area as the market's moving sideways, and then wait to see if it would break out above the resistance. In this case, it did. So we would simply buy right above that resistance area, anticipating that those prices will keep climbing higher. And if they did here, so we would buy above the resistance, and we can see we have a nice breakout. It looks like a small movement, but it's actually hundreds of pips. This is a daily chart that we're looking at. So each candlestick represents 1 day's worth of trading. The high, the low, the open, and closing price points that the market traded at during that day. So we're really looking at the big picture. We're looking at about 10 months, almost a year's worth of trading. So it may look like a small movement, but because it's such a big time frame, we're looking at the big picture. It's actually representing hundreds of pips of movement here that we're seeing. Now let's go ahead and talk about trend lines a little bit. I said we'd get back into support and resistance and how it's linked to the trend. So we're going to do that right here. Now, as I've mentioned already, in an uptrend, a series of higher lows are joined. In a downtrend, a series of lower highs are joined. And one question that we always get is when you're seeing a trend and then you see a pullback or a retracement, how do we know that the market is retracing versus an actual change in that direction, in the trend direction? And here's the answer to that. 2 price points are needed along with a third one to really confirm the trend. So I'm going to show you on a couple charts exactly what I mean by that. Here we can see that those prices have dropped to this low price area here, and then we see that the market is starting to turn around. So at this point, we may be wondering, is the market just doing a small retracement and then it's going to turn around and keep that downward trend going, or is the direction of the trend overall changing? Now what happens is that we can see that the market keeps going up. We can see those low prices getting higher. Now, we can see we do have a pullback here, and then the market kept going. So 2 price points with our trend line. Remember, in an uptrend, we connect the support areas. So 2 price points here are needed. Third one really confirms the trend. So we would connect A to B, and then we're just going to push it out into the future, even though at this point maybe we haven't seen all this future trading. And let's just leave it there. Just say that we had drawn that trend line and just examine this and study it and see what really happened. Now, eventually, you can see at this point here, without us doing anything, the market came right back to that trend line. Those trend lines act as an angled, magnetized sort of area that the market will oftentimes gravitate back to. And we can see that it did hit that trend line a third time at this point. So that really confirms a nice trend. Anything above that is going to tell us that the market is in a very strong trend, and in this case, that uptrend. As we can see, the market eventually came back down and tested out that trend line again, so 4 times. And then you can see how strong that trend is because look at how the prices really jumped up at that point. Now this uptrend would have been great to do some trend trading. That's a whole nother webinar, a whole nother strategy, but do some research on that. Another very easy way to learn how to trade this market, just using another strategy, basically trading off of that trend line. The trend is your friend if you're doing trend trading, and as the market is going up, we can see that the market keeps coming down and testing that trend line. So if the trend is our friend, we don't ever want to go against the trend. In an uptrend, we'd always be taking those buy positions, buying at the trend line each time the market came down and touched down on it. If it was going in a downtrend and you were trading the trend, then you would always be taking sell positions, anticipating that the market was just going to bounce off of that trend line and keep continuing down. Now, I'm going to show you just another example of confirming with a trend line. Here we can see that those low prices are getting higher, the highs are getting higher. Beautiful trend here. As it did finally top out at this area, this is a daily time frame we're looking at as well. And here we can see that eventually those prices dropped at this point and then came back up to retest that trend line again, as you can see. So it's retesting it, hit it a couple more times, and then simply bounced off of that. So at this point, we could draw the trend line, really. We could connect A to B here. And then let's push it out into the future. And then we can see that eventually the market came right back to that trend line again. And then we can see that the prices really dropped at that point. So again, we were able to connect at least 3, maybe even 4 times that the market really tested that same price area. Got a couple double tops going on, which are some reversal patterns. Chart pattern identification, another very easy, simple strategy that you can learn and use to trade this market. Do some research on that. But here we can see at this point the prices really dropped, really confirming we have a very strong downtrend. So now what we want to do is we want to go ahead and focus in on some very specific major support and resistance levels. Now, as you can see so far, the market is always creating a lot of different support and resistance levels. We want to focus in on what we call major key critical support and resistance levels, meaning that should the market finally break those price levels, the market has a tendency many times to keep going in that direction. So right now, I'm going to give you a 3-point checklist, and you can write these down, have them next to your computer, next to your charts when you're using this strategy. And the more we can check off on our checklist, the more significant that price level is to us, that support or resistance. Now, the number 1 point on our checklist is that major support and resistance often occurs at psychological price levels such as round numbers. Now, the reason for that is because if you really think about it, who's trading this market? It's people trading this market from all over the world. And what do we know about people is that we love round numbers. They're easier to work with, easier to deal with, easier to remember. If you go to the store and something costs $1 and change, aren't you looking for that change because you don't want to break your whole even dollars? Well, you're going to see much of that sort of mentality or psychology reflected on your charts as well, even though they're very technical. Remember, it's people trading this market all over the world. And so you'll see that reflected in your charts, that oftentimes the market will gravitate back to those round numbers. I'll show you a couple examples of this. Here we can see that the prices have risen up to this high price area here. Hit it about really 3 different times, right at that 134 level. And then we have that retracement. Now, this is the lowest price area that the market was able to retrace to, creating that nice support. And it's right there at 129. Bounces off of that, and then we can see that the market is climbing. And look where it climbed to. We can see that that resistance area is just a sort of a magnetic area that the market is drawn right back to. That's something you want to look for. Those previous support and resistance areas that the market is creating will oftentimes be areas that the market gravitates back to. So by identifying this resistance level, drawing this line all the way out into the future, even if we haven't seen any of this market movement yet, because it is in the future, that's going to help us as the market is moving up. We can almost anticipate where the market may be headed. It's headed back up to that 134. Those buyers are going to try to get those prices past that 134. They weren't able to do that here as those sellers took over, but they're going to give it a try again. So knowing that, we almost know where it's headed, and now we're just waiting for a breakout. And we can see that the market eventually did break through that 134. So using that breakout strategy, we could simply buy right above that price area, anticipating that those prices were going to keep climbing higher. We can see that they did here, and then we have a retracement. Now look at the market climbs back up to this price level, and this is right at 137. Those buyers finally break through that level. They're breaking through higher up to 138. And then eventually we see we have a nice retracement right back to that 134. That previous resistance now became support. Now eventually the market headed back up to that 137, broke through that, eventually broke through that 138. We could have bought each time the market broke through that nice resistance, and then that nice resistance here. And then notice where the market came to, went all the way up to 143, really topping out at that price level. Now, showing you one more example here just very quickly, we can see that the market has come up to 191 here, creating a nice resistance all across the board. We do have a slight pullback as the market came down to 185. Now, eventually, the market headed back up to that 191, broke through that, so we could have bought above that price level, anticipating that the prices were going to keep climbing higher. And as you can see, they did. In about a week and a half, the market climbed about 700 pips. Not bad, right? Now we do have that retracement as the market created support at 193. Eventually, the market broke through 198, ran about 100 pips in one day, just a very quick run up, and then we have that retracement. The market creating support at 192 and then resistance there at 197. Now, number 2 on our checklist is that the more times a key price is hit and then bounces off of it, the more significant that price level becomes. So if you remember our example of a multi-story building, the more times a floor or that support is tested, stomped on, but doesn't give way, the greater its significance is. So if those testers fail enough times, they may simply give up on that floor and move up to another one. However, if the floor finally does give way, the effect can be huge. So for example, this chart that you're seeing in front of you, I'm going to give you some specifics on it. That way you can go back, recreate this, and study it when you have a little more time. And what we're looking at is a euro-dollar chart. This is a daily time frame. And we're going to go back all the way to 1999. Long time ago, but this is such a great example. We didn't want to miss this here. We really wanted to be able to share this with you. Now, as you can see, I've drawn a line right at this area here. So we'll just pretend like the market's only gotten to about this point. And this price level right here is very key and critical to us. And what you're seeing here is you're seeing that the market has tested parity 4 different times. Parity is $1 exchanged for €1. So there's that dollar mark, which rarely ever happens with any currency pair. So if that happens, believe me, everyone all over the world is watching that currency pair to see what's going to happen, to see if the market will finally break through that $1 mark and go below that. Now, what you see happen here is you can see that the market came back and tested that price area about 3 more times in January. And then in January, it finally broke through. So this would have been such a simple strategy. We simply could have sold here right below that support level once the market broke through, anticipating that the prices will keep going lower. We can see that they did. Now we have that retracement, which will often happen. Oftentimes you'll see that breakthrough, especially of a major support and resistance area. You'll see that initial fast movement, quite a few pips in this case, 300 pips. And then oftentimes you'll see a retracement before the market keeps heading back down. And look at where it retraced to. That previous support now became resistance. And then we can see at this point that those prices really dropped. Now, we want to give you another example, and this is just the reverse. Now, the more times the ceiling is poked out or tested but doesn't give way, the greater its significance. If that poking fails enough times, they may simply give up on that ceiling or that resistance and move down to another floor and work on another ceiling. So we can see that represented here on this chart. We have all of this downward movement. Now we have a retracement happening, and what's happening is the sellers are taking over as those prices are moving down. However, those buyers are trying to get back into the market. They're going to try to get back in there, and we can see that reflected. They're trying to push the prices up. However, they've really hit a major resistance area. So those sellers are just saying, no way, we're not going to let you go any higher than this. And they really stalled at this area, creating this nice resistance. Eventually, if they don't get their way, those buyers, if they can't go any higher, they're simply going to give up on that price area. And we can see that here as those sellers really take over, and then they just drop those prices and the market just plummeted at that point. Now, number 3, this is something that I've already mentioned, but you'll really see it very nicely on a couple charts here. After a key price is broken through, it often reverses its role. So previous support will often become resistance, and then resistance often becomes support. So we can see here that we have this support level, and then we have a breakthrough, and now we have a nice trend starting. So those lows are getting higher, those highs are getting higher. Notice where the market created some nice resistance right back at that previous support. Anytime there's an area that the market keeps gravitating back to, we definitely want to take note of that area, because that could be an area in the future that the market will gravitate back to. And we can really see that. Here we see that we have this retracement, and look at where it retraced to. This area is now a support area where it was previous support and resistance. And then the market takes off, tops out, and then we have a retracement. And notice where the market is retracing to again. This is a nice support level here that the market has created. If we go back, we can see it was previous support, it was previous resistance over and over again. And then eventually the market did break through, running literally hundreds of pips in just 2 days. And then we can see that the market is turned around here. We can see it does that initial fast breakout. Now it's just doing that retracement, and notice where the market retraced to. That previous support has now become a level of resistance, and then we can't see all of the future here, but possibly it's bouncing off of that before it just turns around and makes its way up. Or excuse me, turns around and plummets, making its way down in that case. Now, let's go ahead and get into our trading strategy. Now, I've shown you what support and resistance is, how to identify it, how it's linked to the trend, specifically looking at major support and resistance levels. So now what we want to do is we want to use those with our trading strategy. And what we see here is we see at this point that the market is moving sideways. So the first thing that we would want to do is we want to identify that significant support level as the market's moving sideways. And so we've identified this level right here, maybe even pulling up this line a little closer. Nice support level that the market has created. Step number 2, we need to identify that significant resistance level. So we've done that right here, maybe even pull this up a little higher. And then we can really see at this point that we have a very strong resistance area. So now here's our trading strategy. We've identified the support, we identified the resistance. Now we have to look for that breakout to see which side the market's going to break through. In this case, we can see that the market broke through that resistance area. So what we would do is we would simply buy right above that resistance area, anticipating that those prices we're going to keep climbing higher, which we can see that they did. We had that rally up, and then eventually we had that pullback. And if you notice where the market pulled back to, it pulled back to that previous resistance area, now making it a level of support. So we definitely had that role reversal going. We could have really gotten back into that trade buying upon the bounce off of that resistance area. Now I want to show you another example, and this one this time is going to be the breakout of support. Our last one was the breakout of resistance, but we're still using that same technique. We're looking at that sideways movement. We go ahead and identify this level here as being significant. Let's pretend like the market's only about at this price level here. Now what's telling us that this area is significant? Again, we're going to go back to our checklist, and the more we can check off, the more significant that this price level is becoming. First of all, it is on a round number, and we know that that is going to be a key major area if it lands right on that round number. So we can check that off. Number 2, look at how many times, this is probably the most obvious, how many times the market came down and tested that area over and over again. So we can check that off. So frequency of time that the market has hit that same price area. Now, if we go back in time, we can even see that our previous resistance has become an area of support. So there is that role reversal that we were talking about. So according to our checklist, we were able to really check off everything. And remember, the more that we can identify, the more we can check off, the more significant that price level is becoming, meaning that should the market finally break through, there's a good chance it'll keep going in that direction. Now, all we do now is wait. It's just kind of a waiting game. We have to be patient as we're waiting to see if the market's going to break through that price area. And we can see eventually it did. So we can see here that all we had to do was sell below that support level upon the breakout, anticipating that those prices were going to keep dropping lower, which we can see that they did. You can see the market kind of bottomed out at this price area. Now it's doing that retracement. And we can see that the market may possibly be retracing back up to that previous support, now making this a nice area of resistance. So we see that role reversal potentially happening again. Now I want to look at another example using the same strategy. And this one is a breakout of resistance, as you can see. Starting at the beginning, we can see those low prices are getting higher. Those high prices are also getting higher. And then we can see they topped out at this price level here, creating this nice resistance. We have a retracement, and this is the lowest price area that the market was able to retrace to, creating that nice support level. And if we go back in time, we can see that our previous resistance is now a level of support. So that's really showing that nice strong floor. Now the market's headed back up, and really we can anticipate where the market may be headed, right? It's headed right back up to that previous resistance. It finally broke through, so we could simply buy right above that price area, anticipating that the prices were going to keep climbing higher. We can see that they did. We can see that they did top out at this price level. Now we have a retracement, and notice where the market retraced to. That previous resistance has now become a level of support, so we do see that role reversal happening. So we could simply buy upon the bounce off here, getting back into that trade. And of course, within this trend, there was a lot of breakout opportunities, a lot of areas that we can see that the market started moving sideways, and then all we had to do was buy above that resistance within that sideways movement each time that the market broke through and then headed up. Now, we're going to go ahead and wrap up our session here. And what we always like to do at the end of our sessions is we like to take any questions that you may have. So at this time, if you do have any questions, you can simply type those into the chat window at the bottom of your screen. As I'm answering these questions, you can go ahead and keep typing in. But one question that we have is, how can we determine our resistance and support zones, or let's see, exist some operation to identify our zones? Well, first of all, it's going to depend on which time frame that you're using, and you can use any time frame. So let's say that you're doing some day trading. Now, typically day traders are going to use small time frames, anywhere from maybe 10 minutes, 15 minute, 30 minute, up to 60 minute. So let's say that we are looking at a 60-minute chart. Well, we're just going to be looking to see if that currency pair is starting to do that sideways movement on that 60-minute time frame. So that's how you're going to determine it. If you see that those low prices have leveled out, moving sideways, and those high prices have leveled out as well, that's considered a ranging market or consolidation or a channel. You can call it any of those. And then what you do is you identify that support, you identify that resistance. Just drawing those lines really helps you see it very clearly by doing those lines, and that's all part of our technical analysis. And then you're just waiting for the breakout. So again, if it breaks above the resistance, you buy above the resistance. If it breaks below the support, you're going to sell right below that support level. And you can use that strategy on any time frame. Let's say that you like to use large time frames, do some position trading. Well, you're going to use daily, weekly, monthly charts if you're doing position trading, meaning that you may hold open that trade anywhere from weeks to months. You're really in it for the long haul, looking at the big picture. Well, again, if you're looking at a very large time frame and you see that sideways movement happening, you identify the support as it's moving sideways, identify the resistance, and then you're just really waiting for the breakout of that support or resistance. Okay, I see a couple people typing in, so we're just waiting for the questions. Okay, looks like we don't have any other questions coming in, so we will go ahead and wrap it up here. First, I want to thank everyone for joining us on our class. It's been a pleasure. Check out our other webinars. We have quite a few other educational webinars on our webinar page on our site, and we are www.forex.com. If you go to our homepage, if you click on the tab there that says Learn, that'll pop up some other tabs where you can get a lot of free education. And one of those, it's going to say Webinars. If you click on that, we have quite a few other webinars that we do host for some nice education for you. We also have a free trading platform that we can offer you to download, absolutely free to use. That does come with a free charts that you can use. They do have a live data feed. You're seeing real-time market action as the market is open, as it's being traded. We have a free economic calendar. We have a free glossary, basically, of all the terms that we talked about today, and then some nice videos that you can really take in more education. We do also offer actual education packages, our Learn to Trade Forex and Learn to Trade Forex 2. That way you'll have a 24-hour-a-day access to an online curriculum, and that way you can really learn very effectively how to trade this market, really learning on your own schedule. So check those out. Again, thank you so much for joining us, everyone. It's been a pleasure, and we'll see you next time. Bye-bye.